Okay, so as far as assets that have had some depreciation on them since its initial acquisition and then later disposed of for a certain amount, you have to figure out the adjusted basis, which is the initial basis minus any cost recovery that has been allowed. So we have this example of this company that owns a computer, which is a 5-year Macker's recovery period. Purchased 2 years ago for $1,200. Financial statement purposes, the computer's depreciated over 3 years using the half-year convention and straight line method with no salvage value. What is the adjusted book and tax bases for the computer after 2 years of depreciation? For book purposes, financial accounting purposes, the adjusted basis after 2 years is $600. So again, for financial purposes, financial accounting purposes, the adjusted basis and book value are one and the same. Under the tax rules, we just call the adjusted basis the adjusted basis. And so there, after 2 years, tax basis is $576. So you can look at the tax tables to figure out the percentages they use there if you want. And so figuring out the gain is simply taking the amount realized and subtracting the adjusted basis at the time of the disposal of the assets, gain or loss. And so back to the example, this company sells the computer in the previous example. The adjusted tax basis is $576 for $400, and so what they're going to have is a loss of $176. Okay, so there's the summary of the formulas for computing gain or loss in a disposition. See where else I want to go with this. I encourage you to look over examples in 11-2 as well as 11-3, 11-4. And what the previous slide shows exhibit 11-2. This is kind of a running example they have in the book, so make sure you look over that. Okay. So again, after you figure out the gain or loss, you have to determine what is the character of that gain or loss. That depends on how the assets are used. If the assets are used in a trade or business and they are not inventory and accounts receivables, you have to determine whether or not the holding period for the asset is 1 year or less or more than 1 year. If it's 1 year or less and used in a trade or business, it's ordinary income. If it's used for more than a year, it's considered a Section 1231 asset and is dealt with accordingly. We'll talk more about Section 1231 assets if and when we run across it in taxation of business entities, which I am teaching in the next term. Again, back to our example here, if the property is used for investment or personal use purposes, if it's a short-term asset, it's a short-term capital asset. If it's and thus either a short-term capital gain or loss. If it's long-term, it's a long-term capital gain or loss. And again, if it's inventory and accounts receivable, it's ordinary income, as it should be, if you think about it. All right, so those are kind of the rules for both individuals and corporations. Some of that we've already looked at, so I'm not going to go over it. Corporations, don't worry about, because that's the next class, the next course. Okay, so I just kind of wanted to run through that and make sure that you've got a good basis. And then if you take the advanced course, we'll deal with the 1231 assets and how we deal with that. The only other thing I want to talk about here in this chapter is like-kind exchanges, or non-recognition transactions, of which the most common is like-kind exchanges. Let's say you have a piece of real property, and this like-kind exchanges deals with both real and personal property, but the rules concerning like-kind exchanges of real property are much more flexible and broad than like-kind exchange rules for personal property. So our main focus is going to be on like-kind exchanges of real property. I mean, if you had enough time to write a paper on this subject, it's a great subject to write a paper on, but I'm not sure how you write a paper on a subject that you only have 3 days to write the paper on. But anyway, your choice if you haven't started. So, for an exchange, and what you're trying to do here, again, this is under the heading of non-recognition transactions. If you exchange one piece of property for a like-kind piece of property, what's the effect of this? Well, you're not putting off permanently the recognition, because that certainly is a sale or exchange. It's an exchange, just like it says. And so that should be an event that is a realizable event. But if it's an exchange of like-kind property, the tax code allows you to defer the gain until the disposal of the property that you received in the exchange. And so, for an exchange to qualify as a like-kind exchange for tax purposes, the transaction must meet the following 3 criteria. The property must be exchanged solely for like-kind property. So for this exchange to be totally tax-free and deferred, the property has to be exchanged solely for like-kind property. The taxpayer can't receive cash. The taxpayer can't receive, maybe a motorcycle or a car, or some other type of property that's not like-kind. Let's say and again, it's pretty broad what is, for real property at least, what is like-kind property. And so, you know, you could basically have like an apartment building and exchange it for, you know, pasture land if you wanted to. Even though they're not similar in the way they look, they're still both real property. So the property must be exchanged solely for like-kind property. If not, then at least part of the transaction may be taxable. Both the property given up and the property received in the exchange by the taxpayer must be used in a trade or business or held for investment by the taxpayer. Now, the tax note here that the taxpayer could take property that they used in a trade or business and exchange it for like-kind property that they plan to use for investment purposes. So it could be trade or business property in exchange for trade or business property. It could be a trade or business property exchange for property that they're going to hold for investment. It could be property they hold for investment that the taxpayer holds for investment that they're going to exchange for property that they're going to use in a trade or business. So what doesn't work? Well, either trading property that the taxpayer uses in a trade or business for personal use property, or that they hold for investment purposes that they're going to exchange for personal use property. That's not going to work. Note that the exchange must meet certain time restrictions. These exchanges aren't always simultaneous, and so the code provides some flexibility on non-simultaneous exchanges. And so real property, definition of like-kind property simply means that real property used in a trade or business or held for investment is considered like-kind with other real property used in a trade or business or held for investment. That's pretty broad. And in my example, you've got let's say an urban apartment building that you used for investment, and now you're going to exchange that for, let's say, dirt. Just, you know, it's real property out in a field right now, and you're planning to build a factory there and begin a business. So you're using the real property in a trade or business. So it works, even though the real properties are not anywhere near similar. They're just real property. Now, as I mentioned, personal property, like-kind property, is much more restrictive. And so personal property is considered like-kind if it has the same general use and is used in a business or held for investment. When they talk about general use, what the IRS has done is created these categories. And so essentially what it boils down to is that when you exchange personal property for other personal property, they basically have to be of the same general use class. And so if you look at, try to find it here. Well, they don't have it in this book. Well, it just says that Treasury regulations explain that tangible personal property qualifies as like kind if the property transferred and the property received is in the same general asset class in Rev Proc 87-56. In simpler terms, for personal property to qualify as like kind property, the property given and the property received must be almost exactly the same. And so the example they give is you have a piece of machinery and you're going to exchange it for a new piece of machinery. That works. What doesn't work is if you exchange, let's say, a piece of machinery for a truck or some other piece of equipment, a dirt digger, something like that, road grader. That's not going to work. And note that like-kind treatment, the property that's ineligible for like-kind treatment includes inventory, most financial instruments, stocks, bonds, partnership interests, domestic property exchange for property used in a foreign country. So the property both given and received must be in the United States. As far as property use, just remember you can take property that you've used in a trade or business and can exchange it for property that you plan to use in you're going to hold for investment, or vice versa. That works. Note here, as far as the timing is concerned, sometimes these things are not simultaneous. And so they may involve a middleman. And so what happens there is, and there's companies out there that specialize in these non-taxable like-kind exchanges. And so these companies, usually they're like a real estate broker or something like that, some sort of broker. And what they'll do, they'll take possession of the property that you plan to give up in the exchange. They'll go out there and look for like-kind property that can be received by the taxpayer in a like-kind exchange. Note that the taxpayer must identify the replacement like-kind property within 45 days of giving up their property to the intermediary. So that's kind of a diagram of all that. Note that the like-kind property must be received within 180 days of when the taxpayer transfers the property in a like-kind exchange, meaning when they transferred the property that they gave up to the intermediary. Sometimes it's a half a year. Should be enough time in most cases. And so what happens when it's not a like-kind for like-kind exchange? You know, sometimes, let's say you have real property that has a value of $250,000, and you're exchanging it for other like-kind property, but its value is only $200,000. And so again, the taxpayer is the one with the property they're giving up for $250,000. The other party to this like-kind exchange has the property for $200,000. If it's, assuming it's an arm's length transaction, the other party to this like-kind exchange is going to have to kick in another 50 grand somehow. Let's just assume it's cash. Well, cash is not like-kind property, and so what's the effect of that? Well, the non-like-kind property is known as boot. Why, I have no idea. When boot is given as part of a like-kind transaction, the asset received is recorded in two parts. The property received in exchange for the like-kind property and the property received in a sale, meaning bought by the boot. So when boot's received, the boot part usually creates recognized gain. So in my example, that would be $50,000. The taxpayer receives property worth $200,000, like-kind property of $200,000. That's not taxable until some later time. But the $50,000 cash is considered boot, and they're going to taxpayer's going to recognize gain on that boot, receipt of boot. And so the determination of the basis of the like-kind property received is calculated by by taking the adjusted basis of like-kind property surrendered, the $250,000, and then you're going to add the adjusted basis of boot given. In this case, the taxpayer is not giving any boot, they're receiving boot. So that's a zero. Gain recognized, zero. Well, 50,000. And then here in my example, minus fair market value of boot received, 50,000. So adjusted basis of this like-kind property received is $200,000. Note that the basis of boot received is the fair market value of the boot. Well, what if it wasn't cash that the other party to this transaction was giving? Let's say it was a car. So you'd have to figure out the fair market value of the car on the date of the exchange. That would be the basis of boot received. All right, so that's basically it for Chapter 11. Just wanted to go through those things. I put some homework out there concerning these subjects and nothing more. Hopefully it's not too much.